You know, most people believe investing is about predicting the future. They think the secret to wealth is knowing which stock will explode next, which market will rally, or which trend everyone else hasn't noticed yet. That belief ruins more investors than bad luck ever could. Benjamin Graham learned this the hard way, long before most of us were even born. He lived through crashes that wiped out fortunes overnight, moments when confident investors were reduced to panic, and times when the market punished arrogance without mercy. What he discovered wasn't flashy, but it was powerful enough to outlast generations. Benjamin Graham was born in 1894, long before smartphones, social media, and financial influencers telling people what to buy. He grew up in a world where money felt tangible and loss felt permanent. When his family lost its financial stability early in his life, that experience carved something deep into his thinking. He didn't become obsessed with getting rich fast. He became obsessed with not losing money. That single shift in mindset became the foundation of everything he taught. Graham understood something most people never do. The stock market is not a machine that rewards intelligence. It's a machine that rewards emotional control. He watched brilliant people lose everything because they confused optimism with analysis. He watched average people survive and eventually win simply because they refused to panic. From those observations, he built an approach to investing that didn't depend on predictions, confidence, or excitement. It depended on discipline. He described the market as a moody business partner, someone who shows up every day offering to buy or sell at different prices, often irrational ones. Most people listen to that partner emotionally. When prices go up, they feel smart and buy more. When prices fall, they feel afraid and sell. Graham taught the opposite. He said your job isn't to follow the market's mood, but to take advantage of it. That idea alone changed the lives of countless investors who were willing to listen. One of Graham's most important lessons was this: investing is not about how much money you make, it's about how much you keep. He believed that avoiding big losses mattered more than chasing big gains. This mindset sounds boring, almost unimpressive, but over time it creates something rare: survival. And survival is what allows compounding to work its magic. You can't compound money that's already gone. During the Great Depression, when markets collapsed and fear ruled everything, Graham didn't abandon his principles. Instead, he leaned into them. While others were desperate to escape the pain, he calmly analyzed businesses as if emotions didn't exist. He looked for companies selling for less than they were worth, not because the future looked bright, but because the present price was irrationally low. That discipline allowed him to invest when others couldn't. And that's where real wealth is born. Graham taught that every investment should begin with a margin of safety. This idea is simple but profound. You don't buy something because it might go up. You buy it because even if things go wrong, you're protected. Think of it like building a bridge, strong enough to hold far more weight than it's expected to carry. Most investors build bridges that collapse under stress because they assume everything will go right. Graham assumed things could go wrong and planned for it. This philosophy wasn't about fear, it was about respect for uncertainty. Graham knew that no matter how smart you are, the future will always surprise you. So instead of trying to outsmart uncertainty, he designed a system that could survive it. That's why his ideas worked in bull markets, bear markets, wars, recessions, and technological revolutions. The world changed, his principles didn't. He also warned against speculation disguised as investing. If you buy something only because you expect someone else to pay more for it later, you're not investing, you're gambling. Graham didn't say this to scare people away from markets. He said it to protect them from themselves. Most financial losses don't come from bad assets. They come from bad behavior. Another critical insight Graham shared was that intelligence alone does not make a good investor. Temperament does. You don't need a high IQ to succeed, But you do need patience, humility, and emotional strength. You must be willing to look wrong in the short term to be right in the long term. That's uncomfortable. Most people can't handle it. That's why most people never build lasting wealth. Graham believed the market exists to serve you, not instruct you. Prices are information, not commands. When prices fall, the market is offering you a deal, not issuing a warning. When prices rise, it's offering you an opportunity to be cautious, not greedy. Learning to interpret prices correctly is one of the hardest skills an investor can develop, but it's also one of the most valuable. He also emphasized the importance of separating emotions from decisions. Fear and greed are natural, but they are terrible advisors. Graham encouraged investors to create rules when they were calm and follow them when emotions tried to take over. This is how discipline beats impulse. This is how strategy beats noise. Perhaps the most powerful part of Graham's philosophy is that it doesn't require perfection. You don't need to time the market. You don't need to pick winners every time. You just need to avoid catastrophic mistakes and stay consistent. Over time, that consistency compounds into something extraordinary. Quietly, relentlessly. Many of Graham's students went on to become legendary investors, not because they memorized formulas, but because they adopted his mindset. They learned to think independently, act rationally, and stay patient when others lost control. That mindset is just as relevant today as it was decades ago, maybe even more so in a world driven by headlines and hype. Graham didn't promise excitement. He promised results. He didn't sell dreams. He offered principles, and those principles continue to reward anyone disciplined enough to follow them. This is not a story about getting rich quickly. It's a story about building wealth in a way that lasts. And this is where most people misunderstand Benjamin Graham. They think his ideas are outdated because they're not flashy. In reality, they're timeless because human behavior hasn't changed. Fear still feels the same. Greed still feels the same. And the market still punishes those who ignore reality. What Graham understood, and what most investors still struggle to accept, is that wealth is built not by excitement, but by endurance. Not by prediction, but by preparation. Not by following the crowd, but by thinking clearly when the crowd loses its mind. And this is only the beginning of what Benjamin Graham truly taught about money, discipline, and long-term investing. Benjamin Graham also understood something that feels uncomfortable to hear, especially in modern investing culture. Most people lose money not because the market is cruel, but because they demand certainty where none exists. They want guarantees. They want reassurance. They want to feel smart all the time. Graham believed that the moment you need to feel smart is the moment you become vulnerable. Real investing often feels boring, slow, and even lonely. And that's exactly why it works. He warned investors about confusing activity with progress. Buying and selling frequently feels productive, but it often destroys value. Graham preferred quiet ownership. He believed that once you buy a solid business at a sensible price, your best action is often no action at all. Time does the heavy lifting, not constant decision-making. This idea clashes with human nature, which craves excitement and validation. But markets don't reward excitement. They reward patience. One of Graham's most misunderstood lessons is that volatility is not risk. Price fluctuations are normal. They are emotional reactions, not measurements of value. Real risk is paying too much for something and having no protection when reality disappoints you. Graham didn't fear market swings. He feared permanent loss of capital. That distinction changed everything about how he invested and taught others to invest. He often explained that a stock is not a lottery ticket. It's a partial ownership in a real business. That business has assets, earnings, debts, and obligations. If you wouldn't buy the entire business at that price, why buy a piece of it? This simple question filters out most bad investments immediately. Graham encouraged investors to think like business owners, not traders. Owners focus on long-term value. Traders focus on short-term price. Graham also believed that simplicity is a strength. Complex strategies often hide weak logic. He favored clear reasoning that could survive stress and scrutiny. If you can't explain why you own something in plain language, you probably don't understand it well enough. This humility protected him from overconfidence, which he considered one of the most dangerous forces in investing. He was especially critical of emotional storytelling in markets. He knew that people love narratives. A compelling story can make any investment sound irresistible. But stories don't guarantee returns. Numbers do, cash flow does, balance sheets do. Graham trained himself to ignore exciting narratives and focus on measurable reality. That discipline allowed him to remain calm when others were swept away by optimism or fear. Another key principle Graham taught was diversification. Not because it maximizes returns, but because it protects against ignorance. No one knows the future. Even the best analysis can be wrong. Diversification is an admission of uncertainty, not weakness. Graham believed that spreading risk intelligently was a sign of wisdom, not lack of conviction. He also rejected the idea that investing should be stressful. If your investments keep you awake at night, something is wrong. Either you're over-leveraged, under-diversified, or emotionally attached to outcomes you can't control. Graham believed investing should be approached with calm rationality, not adrenaline. The market already has enough emotion. You don't need to add yours to it. Perhaps one of his most powerful lessons was about expectations. Graham believed that unrealistic expectations are the root of disappointment. Markets don't move in straight lines. Returns don't arrive on schedule. Periods of stagnation are normal. Investors who expect constant progress become frustrated and make poor decisions. Those who accept uneven progress remain steady and eventually win. Graham also emphasized self-knowledge. He believed investors should understand their own temperament before choosing a strategy. Some people can tolerate volatility, others can't. There is no shame in either. The mistake is choosing an approach that doesn't match your emotional capacity. The best strategy is the one you can stick with during difficult times. He often reminded investors that the market is indifferent to your needs. It doesn't care about your timeline, your goals, or your emotions. Expecting fairness from the market is a mistake. The only thing you control is your behavior. That's where discipline lives. That's where advantage is found. One subtle but profound idea Graham shared was that investing success is often about avoiding stupidity rather than seeking brilliance. You don't need genius. You need restraint. You need to avoid obvious traps, overconfidence, excessive debt, emotional decision-making, and blind optimism. Remove these, and you dramatically increase your odds of success. Graham also believed that financial independence is less about income and more about behavior. High earners can remain broke if they lack discipline. Modest earners can build wealth if they manage risk and stay consistent. Investing is not reserved for elites. It rewards those who respect its rules, regardless of background. As markets evolved and technology advanced, Graham's principles remained relevant because they were built on human psychology, not market mechanics. Fear, greed, impatience, and overconfidence are timeless. So are the mistakes they cause. Graham's work wasn't about predicting markets. It was about protecting people from their own worst instincts. He also taught that humility is a competitive advantage. Admitting what you don't know keeps you cautious. Caution keeps you alive in markets. Survival allows compounding to work. Compounding over time does extraordinary things quietly. That's the irony of investing. The less dramatic your approach, the more powerful the outcome. Graham never promised fast results. He promised durable ones. He didn't attract thrill seekers. He attracted thinkers. People willing to trade excitement for consistency. People who understood that wealth built slowly tends to last longer. And yet, even with all this wisdom available, most people still ignore it. They chase trends. They follow headlines. They panic when prices fall and celebrate when prices rise. They do exactly what Graham warned against. Not because they're foolish, but because resisting emotion is hard. Discipline feels unnatural. Patience feels uncomfortable. But Graham believed that discomfort is often the price of success. Not dramatic suffering, but quiet restraint. The ability to do nothing when doing nothing is the right choice. The ability to act when others are frozen by fear. That balance separates investors who endure from those who disappear. This is where Benjamin Graham's philosophy stops being about money and starts being about character. Investing exposes who you are under pressure. It reveals whether you follow rules or impulses, whether you think independently or seek approval, whether you value long-term stability over short-term excitement. And the truth is, Graham's greatest lesson wasn't about stocks at all. It was about self-control, about building a system that protects you from yourself, about respecting uncertainty instead of fighting it. Because once you understand that, investing stops feeling like a gamble and starts feeling like a process. And that process, when followed with discipline, leads to something far more valuable than quick profits. It leads to confidence. It leads to clarity. And it leads to freedom. Benjamin Graham believed that true wealth is not just measured in numbers, but in peace of mind. He saw money as a tool, not a scorecard. The purpose of investing in his eyes was not to impress others, but to create stability for yourself. When your finances are stable, your decisions become clearer. Fear loses its grip. Urgency fades. And that calm is something money alone cannot buy unless it's built the right way. He often warned that the biggest enemy of an investor is not the market, but impatience. Impatience pushes people to abandon good strategies at the worst possible moment. It convinces them that slow progress means failure. Graham understood that progress in investing is often invisible for long periods. Nothing seems to happen. Then suddenly, years later, the results appear undeniable. Those who waited are rewarded. Those who rushed are gone. Graham also believed that discipline must be automatic. You shouldn't rely on willpower alone, because willpower fades under pressure. Instead, he encouraged creating rules that remove emotion from decisions. Decide in advance how you will invest, how you will react to market declines, and how much risk you are willing to take. When chaos arrives, and it always does, your rules guide you when emotions cannot. He knew that markets would test every investor eventually. There will be moments when prices fall sharply, headlines scream disaster, and confidence disappears. In those moments, Graham's philosophy becomes most valuable. He taught that downturns are not punishments, they are opportunities. Not because prices are guaranteed to rebound immediately, but because value becomes easier to find when fear dominates. One of Graham's most enduring beliefs was that independence of thought is essential. If you rely on others to tell you what to think, you will always be late. By the time something feels safe, it is usually overpriced. By the time everyone agrees, the opportunity is often gone. Graham encouraged investors to think for themselves, even if that meant standing alone. He accepted that being right often feels uncomfortable. It can mean buying when others are selling. It can mean holding when others are celebrating. It can mean doing nothing when everyone else is acting. This discomfort is not a sign of error. It is often a sign that you are thinking independently. Graham also emphasized that investing success compounds beyond money. The habits you build, patience, discipline, rational thinking, spill into other areas of life. You become less reactive, more deliberate, more confident in uncertainty. These traits are valuable far beyond financial markets. He believed that wealth built slowly is wealth built to last. Fast money often disappears as quickly as it arrives. But money built through discipline tends to stay because the behavior that created it doesn't vanish. That's why Graham focused so much on process rather than outcome. Outcomes fluctuate, process endures. Even late in his life, Graham remained humble. He never claimed certainty. He never promised guarantees. He acknowledged mistakes openly. This humility protected him. It kept him learning. It kept him grounded. In a world obsessed with confidence, Graham chose caution, and that choice made all the difference. What's remarkable is that his ideas remain just as relevant today. Technology has changed. Markets move faster. Information travels instantly. But human psychology is unchanged. Fear still causes panic. Greed still fuels bubbles. And discipline is still rare. That's why Graham's principles continue to outperform excitement over the long run. He didn't teach people how to beat the market every year. He taught them how to survive the market for a lifetime. And survival over time leads to success. That is the quiet truth most investors overlook. Graham believed that financial freedom is not about timing the perfect moment. It's about consistency over imperfect moments. You won't always invest at the bottom. You won't always sell at the top, and that's fine. You don't need perfection. You need persistence. He also understood that the greatest reward of investing wisely is not wealth itself, but choice. The choice to walk away from stress. The choice to take time. The choice to live on your terms. Money is simply the enabler. Discipline is the source. As you reflect on Benjamin Graham's philosophy, one truth becomes clear. Investing is not a competition against others. It's a long conversation with yourself, your patience, your discipline, your ability to stay calm when the world is loud. Graham showed that ordinary people can achieve extraordinary results by doing ordinary things consistently well, by respecting risk, by valuing safety, by thinking long-term. There is nothing glamorous about it, and that's exactly why it works. Most people will ignore this wisdom. They'll chase trends, they'll follow noise, they'll react instead of plan, and they'll wonder why financial security feels out of reach. But a few will listen. A few will apply these principles quietly, steadily, year after year. Those few will build something real, something durable, something that lasts. Benjamin Graham didn't just teach people how to invest. He taught them how to think. And once you learn to think this way, markets stop feeling intimidating. They start feeling manageable, predictable in their unpredictability, and full of opportunity for those prepared to wait. That is his legacy, and it's available to anyone disciplined enough to follow it.